News Talk 94.5, WPTI, 96.7 FM, WTOB. You're listening to the Wealth Guardian Show with Doug Ray, helping you retire the job and keep the paycheck. This morning, you have Brice Payne and Garrett Ray in the studio, and today we are talking about beware of retirement half-truths, these little sayings that are out there that might need a little bit more context. How you doing, Brice?
I'm doing well, Garrett. How are you?
Doing okay.
Broncos undefeated so far this preseason.
Preseason week 1.
1-0. That's I'm just going to say that because it's probably the only week I'll be able to say that for the Broncos being undefeated. So after that, Anyway, how are you?
I'm doing well. I also got into the NFL, swing of things, if you will, as much as preseason allows. So don't think we'll see too many people of relevance for another week or two, but it's good to get back in the swing of things and see what the coaches are thinking.
It is indeed. Yep. And this weekend, your dad's team goes against my team, Pack versus Broncos. So we'll see who wins that one.
That'll be good.
At any rate, let's go ahead and do our Wealth Guardian Service salute. Every week we want to take just a minute here and acknowledge, recognize, appreciate and say thank you to all those who put on the uniform to keep the Stars and Stripes and our country's borders safe. As we have always known it to be, it's oftentimes a job, a task that goes unappreciated, and we just want to make sure that everybody out there who does put themselves and their family to some degree as a sacrifice for their time and their love and attention that they dedicated to the flag and to our country, we want to say thank you. So we do appreciate you, and Garrett, of course, and Doug here at the Wealth Guardians have dedicated some of their time to that very cause. So thank you guys as well. Before we get started into beware of these retirement half-truths, let's take a moment and just better get to know your Wealth Guardians financial planner. The question I want to ask Garrett, and that Garrett will in turn ask me, is, Garrett, I think we're both like to think that we're pretty good at our job here, but what job would you be the worst at?
Yeah, it was funny when you asked me that question. So I'm an engineer by degree, did, 11 years in engineering manufacturing, and then, into a very numbers-based field here in finance. So I really struggle with anything that involves a lot of creativity. So my answer is marketing. Not that I don't think it's very important, but you have to have a creative mindset in how do I catch people's ears? How do I catch people's eyes? That has just not been a strength of mine. I can certainly recognize the importance. But when it comes to me coming up with original marketing content,
right,
not my strong suit.
All right, very good. Fair enough. I think I would make an absolute terrible high-rise window washer.
Oh, well, yeah.
Because I have a huge fear of heights, and oddly enough, unless over water. If I am over water, all of a sudden that fear is completely gone because I figure, and again, irrational, right? I figure, I'll fall in water. That's safe. You can't get hurt falling into water. Yeah. So, I would just be cowering on the bottom of that scaffolding thing that's hanging out there 50 stories up in the air. So that's what I would be terrible at. But I do like to think that you and I both are pretty decent financial planners at this stage of the game.
Yeah.
All right. Well, you ask yourself that question. What would be the worst job that you would be at out there? And is that actually your job? I hope it isn't.
Right.
Let's go ahead now and get into these beware of retirement half-truths. Garrett, you and I, we sit down with probably about 50 couples a year. And a lot of times they'll come to the table, the financial planning table, with some ideas that they have heard over the years.
Little rules
of thumb that you're like, I can see where that originated, but it really makes no sense when you take it down to the bare bones of things. So let's go over some of these, and you tell us if this is something that you thought you understood to be a truth, and we're telling you now it is not a full truth. And the first one here is, don't worry about those losses because the market always goes up in the long run. Now, technically speaking, does the market always go up in the long run? Historically speaking, it has, right?
It has.
Probably will continue to do that. But why don't worry about those losses? The first part of that statement, that's not necessarily something you need to follow, right?
Yeah, I mean, I guess my answer would be it depends. And so what I mean by that is you are just starting your career, you're in your mid-20s, your mid-30s, you're getting into this investing thing. You probably don't need to be overly concerned about market losses. Your name of the game is consistency in your investing and trying to grow over time your portfolio. And that's the key word, over time. When you're talking about someone who is in their mid to late 50s, certainly when they start getting into their early to mid 60s and they're thinking about retirement, yes, then your time horizon is much, much shorter from when we're going to be using those funds to support, in many cases, a majority of our income in retirement. So then your time horizon does matter quite a bit, and that's when we don't want to have losses. I mean, I don't have a chart in front of me, but just going off of memory, when we had the financial crisis of 2007, 2008, from peak to trough, the S&P took about a 53% haircut.
Right.
And it didn't get back to where it started for about 6 years.
Yeah.
So you tell me, if you're 63 years old and looking forward to retirement at around, say, 65, would you be happy with a 50% haircut? Probably not. So that's when I say it depends, and timing is everything. So have a different plan for a different stage in life.
Right. And, everyone's familiar out there when we talk about risk. Everyone's familiar with market risk or stock risk. A lot of people are familiar with inflation risk. But there is another type of risk out there called sequence of returns risk, which is one that a lot of people aren't familiar with. And that can show you, if you play that out, can show you how having losses at the beginning of your retirement are drastically more substantial to the output of your plan than if they'd happened, those substantial losses happened later on in retirement. Mm-hmm. So, it's something I would say you do need to worry about those if your time horizon, Garrett, as you were saying, is shorter than longer. If you do have a long time horizon, maybe you don't need to worry about it as long as you can stomach the losses. If you are just tuning in, you're listening to the Wealth Guardian Show with Doug Ray. In the studio this morning is Garrett Ray and myself, Brice Payne. And we're talking to you about being aware of retirement half-truths. What are some of those little nuggets of truth out there that might not really be as accurate as you think? And so the first one we were talking about there is don't worry about losses because the market always goes up in the long run. The next one we want to talk about here is the fees in your portfolio are less than 1%. And Garrett, I can't tell you how often somebody comes to us, they go through the planning process, and we really dive into the fees, the total fees, cost, expenses that a portfolio incurs. And the one that everyone's familiar with is the advisor fee. Sure. And they think, well, Brice, my advisor only charges me X percent. 1% is a very typical advisor fee. Well, my costs or my fees on my portfolio is only 1%. Yeah. Well, that's only if you're looking at the one fee.
Yeah, the advisory.
The advisory fee. And that is, unfortunately, that is the one that a lot of people think the fees stop at.
Right.
And that is not. There are a lot of other fees. And we dedicate usually our planning process is 4 meetings, and we dedicate a lot of that second appointment and a little bit of the third appointment to what fees your portfolio is currently undergoing. We do a huge, deep analysis on it with a software program called Y Charts.
Yep.
And we uncover, and that's why we call the second meeting the eye-opening meeting.
Yeah,
the discovery meeting, but it's called the eye-opening meeting, the second one, because people are not aware of how many fees or what the total fees on their portfolio. And I'll give you a quick example. Outside of the advisor fee, there might be what's called a money manager fee. The advisor fee is the one who designs the overall portfolio to begin with. But if you're just in mutual funds and he's only evaluating that on a yearly basis when you have the annual review, you probably don't have a money manager fee. But if you have somebody who is tending to your portfolio allocation on a day-by-day, week-by-week basis, meaning it's being adjusted not just at the mutual fund level, but at a higher level and a more micro level as well, then you probably have a money manager fee. That could be another 1%, and a lot of people aren't aware of that. You could have, if you have mutual funds in your portfolio, every mutual fund out there, ETFs and mutual funds, have an expense ratio on those as well. So you have to analyze the mutual fund expenses. Every mutual fund has trading that goes on inside of it. And those are what we call hidden costs or trading costs. The reason we call them hidden costs is because they are not required by regulation to be put on the statements what the trading costs were in your mutual fund portfolio. You would think that should be, and that's a whole conversation of whether or not that's true. I would tend to agree with you. You should be aware of what your trading costs are in your mutual fund portfolio. But there's more too. There's cash drag. There's a whole bunch of other fees that we break down. And so if you think that your total fees are 1%, the only way that you could really have fees that low is if you are doing the own trading. You don't have mutual funds. You're just investing in stocks and bonds directly. and you're not trading them particularly frequently, and you're not paying any advisor fee. If that's the case, which isn't with a vast majority of people, then you have more fees than just that 1%. So I encourage you to be aware of all the fees that you're paying, because it is probably more than 1%. Garrett, what did I leave out there?
I mean, you covered quite a bit. I mean, that's, you talked the other thing I would add is that if your portfolio consists of variable annuities, then that's a whole nother analysis that we would do specifically.
Yeah, the rider fees.
Yep, around variable annuities and the management expense ratios of those.
Those are even higher a lot of times. Well, good point indeed. All right. Well, we're going to have to go to break here. We've got a lot more of these retirement half-truths that we have to get to, but we do got to get to our trivia question as well here. So we're going to leave Garrett hanging with this. Garrett, are you ready?
I hope so.
We just got done with the Olympic Games. Did you watch those closing ceremonies?
Yeah, my wife and I caught a part of it. Yeah.
I couldn't tell you how bewildered I was by what I was watching there. That was very strange stuff. But I did enjoy the games themselves.
Heavy on the art.
That's true. All right. So, Garrett, with 28 medals, who is the most decorated Olympian of all time? Is it Larissa Latinina? Is it Michael Phelps? Is it Merritt Jordan? Or is it Katie Ledecky? Who is the most decorated Olympian of all time? We're going to get to the answer to that trivia question, and we're going to get to the bottom to see if Garrett knew the answer to that trivia question on the other side of this break. This is Brice Payne. With me is Garrett Ray. The show's The Wealth Guardians, helping you retire the job and keep the paycheck. And this is News Talk 94.5 WPTI. And this is 96.7 FM WTOB. News Talk 94.5 WPTI, 96.7 FM WTOB. Welcome back to the Wealth Guardian Show, where we help you retire the job and keep the paycheck. I'm Brice Payne in the Wealth Guardian studio, along with Garrett Ray this morning. And in this second segment, we're going to continue our discussion on being aware of retirement half-truths. Now, before we answer that trivia question that we threw out there to Garrett, we want to ask you this. Are you planning to retire soon? Maybe not so soon. Are you planning to retire at all? Well, have you met with a retirement income certified professional who is also a fiduciary, somebody who is required by their licenses to look after your best interests? If not, I want to invite you to take us up on a complimentary review of your current situation. As certified retirement planning specialists, we're going to put together a customized written plan with strategies for portfolio allocation, income distribution, Social Security filing, and tax efficiency, with the additional benefit of often reducing both the risk and the fees of your current plan. So if you've put aside at least $400,000 for retirement and you want to take us up on this no-cost, no-obligation review, I want you to call us at 336-391-3409. That's 336-391-3409. You can also go to thewealthguardians.com. That's thewealthguardians.com to learn more. Let us show you how in black and white you can retire the job and keep the paycheck. All right. Well, let's go ahead and get to this trivia question. So, Garrett, here we go. We just got done with the Olympic Games. I probably spent more time watching these Olympic Games than I have on all the other Olympic Games ever combined. I don't know why. I guess maybe that comes with getting older. But I enjoyed them. I mean, it was, the U.S. did really well. I'm proud of them.
Yep.
But here's our question. With 28 medals, who is the most decorated Olympian of all time? Is it Larissa Latinina? Is it Michael Phelps? Is it Merritt Jordan? Or is it Katie Ledecky?
Okay. If it's not an American, I'm going to be in trouble. My initial leaning was Katie Ledecky. I think I'm going to go Merritt Jordan, though. Oh.
Yep, it is actually Michael Phelps, an American. It is Michael Phelps. Now, Michael Phelps has 28 medals. 23 of those are gold.
That's wild.
So that's a huge percentage of them being gold. The next best person is that Larissa Latinina. She has 18. She's from Russia.
Okay.
Merritt Jordan is a female from Norway, 15, and Katie Ledecky comes in at 5th with 14. Okay. So Michael Phelps is just far above anybody else. However, you got to maybe put in a little grain of salt there that it's swimming, because there are so many different swimming events. Yeah. That, if you were a sharpshooter, you're never going to be in the top, because there's not so many different sharpshooting But there's the butterfly, there's the freestyle,
The relay.
there's everything in those.
Yeah.
But anyway, Michael Phelps, he was in the Olympics from 2000 to 2016. His wingspan, 6'7". That's got to help, right, when you're a swimmer. And he was 15 at his first Olympic.
Okay.
15 years old.
Okay.
So, yeah, power to him. All right, Michael Phelps, very good on you. And Garrett, would have wished you'd at least gone for an American there.
Yeah, well, I thought it was a trick question.
Not this time.
Okay.
All right, let's go ahead and get back to these beware of retirement half-truths here. In the first segment, we talked about don't worry about losses. The market's always going to go up in the long run. The fees in your portfolios are less than 1%. So let's move on to the next one. This is another half-truth that people sometimes get stuck on. Bonds significantly reduce the risk in your portfolio.
Yeah, normally that's the case. Bonds are very sensitive to what we call interest rate risk inside the market. And so if you were watching the news headlines in 2022 and even early 2023, what was the Fed doing? They were aggressively hiking interest rates, which of course had a negative impact on bonds. And the way that I break that down is if you flash back 2.5 years ago, you were lucky to find a 10-year bond that paid you 2.5% yield, right? Today, you can go out on the market and you can get a 10-year bond that's paying pretty close to 5%. So if you understand how bonds trade, they basically are sold always at par value, which is $1,000, right? And then they move up and down based on how attractive that yield is in daily trading. So if you owned a 10-year bond from 2.5 years ago that was paying you 2.5% that you paid $1,000 for,
what are you going to sell it for today?
Exactly. But today you can get that same bond at 5%. Who is going to buy your bond without you lowering the price?
Exactly.
And that's how bonds can get you a little bit backwards when we're in a raising interest rate environment. So normally bonds are pretty steady. And normally, too, the Fed doesn't raise interest rates at nearly an aggressive a rate as they have been lately. In fact, it's the most aggressive we've seen since the early 80s with the Volcker Fed. So a little bit unusual in the bond market over the past 2 years. But that being said, you just have to know a little bit about bonds and what you're getting into and what the kind of macroeconomic climate is. That being said, general rule of thumb, are they less volatile than stocks? Over the long run, yes. I'd say right now, no. So
right.
Make sure you have a financial planner helping you out make those decisions.
It can generally be true, but it is not a steadfast truth. Absolutely.
Absolutely.
And if you are just tuning in, you are listening to the steadfast truth that comes from the Wealth Guardians here, Garrett Ray and Brice Payne in the studio this morning, sharing a little bit of your weekend morning with you. Thank you for joining us. I do want to bring your attention to our website. If you're looking for more truths when it comes to retirement planning, we have our website out there, thewealthguardians.com. We've got the events that we have coming up for those who want to come in and sit in on a seminar that we are talking about, whether it's Social Security or taxes and retirement. We've got those listed on there. We've got a whole bunch of white papers that you can browse through, whether it's on Social Security or how to lower your risk or how perhaps something like a fixed index annuity could or could not fit into your overall portfolio if you want to lower your risk. So go to our website, thewealthguardians.com, poke around on there. There's a lot of free information. And if you decide that, hey, I really want to sit down with these guys, it sounds like they know what they're talking about. I'm getting ready for retirement. I want to make sure that I'm going in with the right kind of plan. I don't want to retire too early. I want to have a good idea of how much I can spend in retirement. How reliable is the portfolio that I am as far as quelling me from risk? That's what we help all of our clients out with. If you don't want to go to the website, you just want to give us a call, 336-391-3409 is how you can reach us. No cost, no obligation to sit down with us. And Garrett, the feedback that we get from people who do sit down with us is that it was the most thorough retirement planning process they've ever been through. And a lot of people decide to recommend us to their friends as well.
Yeah, there's a reason that we take typically a 4-meeting process to get from kind of A to Z there, because we want to take the time. We want to educate you along the way. And it's just a really good pace. Now, it is a time commitment, but it's very well worth it.
And that's the feedback that we get, and I like to think that that's true. All right. Getting on to the next retirement half-truth here, you should withdraw 4% annually from your retirement savings. I can't tell you, this is probably one of the most common half-truths out there, and I don't know where it comes from, but you should withdraw or can expect to withdraw 4% annually from your retirement savings. Boy, that's a one you got to really dig into there.
Yeah, I mean, it depends. And I would say this one is just wild because every family is different. We have no idea what this family's budget is. We don't know what the portfolio makeup is. What's the expected rate of return on this portfolio?
What kind of other income sources do they have? That's one of the main ones.
Exactly right. I mean, most everyone has Social Security. Some people have other forms of income, such as real estate, like an investment property, that sort of thing. So
pensions.
This is such a broad general statement that it's
almost not a half truth.
It's
maybe a 1/4 truth.
Yeah, it's not worth kind of the paper it's printed on. You've got to get at some point as you close in on retirement a detailed understanding of what your budget is, what your needs are, and if you need help along the way, we're the folks to reach out for. We help people calculate their budget, understand what their nest egg looks like over several years into retirement, and we model all the way out to age 100 actually, just to be on the conservative side. You have to have that attention to detail and understanding what future expenses you have and why this 4% withdrawal from your nest egg is not necessarily true.
No, I mean, other factors that go into that is what kind of rate of return can you expect on your investments? That's going to be different family to family, couple to couple.
Risk profile to risk profile.
What are we going to assume is the average rate of inflation? That's another assumption we have to make. What is the average COLA, cost of living adjustment on Social Security going to be? Are your accounts, are your investments in IRA accounts or Roth accounts or non-qualified accounts? Mm-hmm. That's going to impact your taxes, which are going to impact what your
take-home pay.
Right. So there's so many different factors in there that you can't just say, oh, expect 4% annual or expect to be able to take 4% out of your investments. That's a silly one right there. All right, let's move on to the next one. Saving just enough to match your employer's 401k contribution is sufficient. I got to be honest with you, Garrett. I don't know that I've encountered too many people who believe that.
Yeah, I think, I think some of this comes a little bit from Dave Ramsey speak. He always encourages people to contribute to their 401k at least up into the match. And
well, I'd agree with that statement.
Sure. But to say that it's sufficient,
right?
That's a little bit, that's one step too far, as they say. But that's a great kind of starting out rule of thumb deal when you're kind of just getting your career going, probably starting a family, that sort of thing. But that being said, not everyone has the luxury to start contributing to their 401k when they're in their 20s and 30s. Maybe you're getting a late start. If you're getting a later start, or let's say that you've got more steady work later in your life than you did in your earlier years, then you probably can't afford to just match the company match.
Right.
Somewhere like a 4 to 5% contribution.
Right.
You may have to have a plan to catch up, and we can help you with that.
Absolutely. All right, let's get on to the last one here before we let everybody get on with their weekend. The last half-truth that we want to talk about is Social Security will cover your basic expenses in retirement. Now, one of the things that we do as financial planners is help clients not just figure out what their investment portfolio should look like, but when we cover all things money in a household, one of those main sources of income for most people is Social Security. You have a lot of different ways of filing for Social Security. But Garrett, Social Security was never designed to meet 100% of what your expenses would be in retirement.
Yeah, I mean, it was not the original intent of the program. And, as we kind of have the luxury of talking to about 50 or so families per year, we find that it also just isn't realistic with what their lifestyle expectations are. If you were really, really, just kind of living just a basic lifestyle, you could probably make just Social Security between a husband and wife or, two spouses work out.
Assuming you have no debt. The mortgage, mortgage is covered.
Right. Mortgage is covered. You have no interest in buying a car for the next 15 years. It's just kind of silly stuff like that, right? What is a more realistic kind of way to think about it is how much help is Social Security going to put towards my family, and what's the gap that I need to make up?
Right.
And does that number seem achievable to us?
Right.
And that little gap analysis there of, okay, we've got a lifestyle about this around, maybe I'm just making numbers here, about, $3,000 per month is what we need. We have Social Security benefits of like $1,800 per month. Does that gap, can we afford that gap?
Right.
So
there's a lot of planning that goes in around Social Security as well. Again, that's what a holistic financial planner will help you figure out when you are wanting to get ready for retirement. At any rate, we are out of time. So let me give you our phone number one more time. It's 336-391-3409. If you'd like to sit down with Doug, Garrett, and myself and go through a retirement planning process to make sure that all of your ducks are in a row, so to speak, and that you're not making any mistakes before you retire. No cost, no obligation to sit down with us, 336-391-3409. Unfortunately, that is all the time we have this week. Garrett, thank you for joining me, and thank you out there for joining us here in the Wealth Guardian studio. We hope the rest of your weekend is everything you want it to be. This is Brice Payne, along with Garrett Ray, the show's The Wealth Guardians, helping you retire the job and keep the paycheck. And this is News Talk 94.5 WPTI. And this is 96.7 FM WTOB.